Good afternoon. Welcome to this week's Sonar Market Insights webinar with our market expert, Zach Strickland, and myself, Brad Ganane, coming to you after a big week in the release of 3.2 Sonar. A lot of new functionality and a few new data sets added, but of course it wouldn't be another week at FreightWaves and Sonar if we didn't add some more data. So to make sure that we don't have a lull in the excitement from 3.2, we're bringing energy
and a few more macroeconomic indicators.
See what I did there with
we're
bringing energy. There you go.
That was clever.
Okay. Well, that's all I got. I'm going to start with that and let you tell us about some of the new energy data that we have.
Well, I'm going to start off with a few of the macroeconomic indicators real fast. We added employment separation rate for various industries just to kind of add a little bit more depth to some of our macroeconomic figures for those of you that are involved in any kind of, not necessarily manufacturing directly, but transportation is tied to manufacturing and industrial sectors very heavily. So as the economy kind of, blossoms or, falls down, you're going to see these separation rates do the same thing. So what the separation rate is effectively the voluntary and involuntary departures from companies based on the basically the percent of the average size of their workforce. So 2.5% of the population and the average population size at any given business is exiting the workforce over a given month, is what that means. So,
and can that at all be tied to? It looks like pretty, it's similar trend to maybe some of the volumes and rates that we saw from some of our freight data with going through 17 and 18. Is there any correlation or how, if any?
It kind of generally follows the economic expansion and growth. It kind of goes up and down seasonally a little bit, but what it's telling you effectively is optionality, and both on the employer end and on the employee end. If employers or employees have a lot of options, the attrition rates, if you will, are going to start climbing, which we've had very low unemployment rates over the past little bit. So that means that they're going to be able to kind of bounce through their jobs a little bit faster.
Sure.
But at the same time, employers, and this is the manufacturing sector, mind you, will also they don't want to have a lot of turnover in their sector. Right. So the more they can hold on to it, that means the business is better, they're paying better, et cetera. So the rate goes down when things are kind of better for the employer. That makes sense.
That makes sense. And we have manufacturing up here. What other sectors do we have available in Sonar?
So I have all this kind of buried out here. If anybody ever needs to know this without me kind of going through a list, a lot of these I just pulled through the macroeconomic table, this kind of sort through search filter here for those of you that haven't played around with it very much yet. You just kind of expand on it. The macroeconomic indicators is probably the largest amount of different data that we have in here. We've touched on just about all of these. Most of these economic indicators are good as kind of high level points of reference, depending on your specific sectors that you're exposed to. For instance, if you are a carrier or a broker or somebody that deals a lot with Home Depot or some sort of, electronics manufacturer like appliances or something like that, you can dig through here to kind of get a good feel for how the economy is doing. Home Depot tends to be a very cyclical thing where everybody has excess income. They're going to go out and remodel their house. Lumber and all that kind of stuff. Housing starts is a good measure on here. There's several indicators on here that are going to give you kind of, some sort of at least historical point of reference for how the market is doing for that particular sector.
Sure.
Any kind of, we have all sorts of commodity data that we're going to be putting in here over the next little bit, but some of these macroeconomic indicators have a use to kind of give you a feel for just the general economic movement. And we have it kind of broken down into construction, manufacturing, and total non-farm. And that will include the construction and manufacturing number. So basically anything that's not agricultural, you're going to see that non-farm tag on there a lot. It's basically just everything else That's what that means. We added the CPI, Consumer Price Index, for the urban consumers, which is kind of the best way to measure inflation in the market. You go out and you buy, your TV and your gas and all that kind of stuff, and it's going to kind of, they actually pull gas out of the Consumer Price Index, but they go out and kind of take a survey on the average cost of just purchasing random stuff, anything that you look at, and there's the gas one right there. Housing, for instance, they pull that out. So how, you bought your house in 2005 for $100,000. Now it's worth $110,000. So the CPI over a year would be 10%, that kind of thing. But this is going to tell you kind of it's a base measure of inflation is essentially what it's telling you. So it costs you a little bit more to purchase things at the end of 2018 versus the beginning. If you look at the chart, all items, but you see we've gotten a little flat here. You see we get a little sideways from time to time where inflation doesn't really go up. A lot of this is tied to the Fed rate, which is another thing that we've added in here. So as the federal government kind of increases interest rates, I think you've probably heard this discussed quite a bit. This also increases the rate at which people are borrowing money, because this is the amount of money that banks are allowed to borrow against. So they have to pay it back with this percentage on it. So the lower this number is, the easier it is to invest in things long-term. Housing is tied to this rate as well. So your mortgage isn't going to be 2.4% at its best. It's going to be this percentage plus the bank's based on your credit score, which hopefully is very good, Brad.
It's fantastic.
I mean, you're starting out on a good note.
I have to.
Yeah.
So how can we tie some of these in to?
These are going to be things like you're going to look at in comparison to freight rates. So transportation is a part of this, not necessarily the federal funds rate, but the CPI. These are all kind of base measures for how much it's going to cost. Like if they raise the Fed funds rate over time, like it may not be a great idea to go out and lease that truck. Right. Kind of turning over your fleet. They do this intentionally to kind of slow the economy. They don't want it to go too hot, too fast. But at the same time, for the most part, we've been at historical lows for a long period of time, and they've been gradually increasing it since, back here in 2009, 2010. And then they just started here in the last several years increasing this rate over that of a very nominal percentage. And it encourages growth in the economy. Sure. And as this number kind of ebbs and flows, that also will impact how people are buying stuff, hence the transportation sector gets impacted.
No, this is really good. And do you have anything that you would overlay or compare with some of this data, whether it be multiple economic indicators, or are there a couple things that you would pair together?
I wouldn't pair much with the Fed funds rate, but I would, you can pair certain things with the CPI, but over time, most of these indicators that I just showed you are going to go up and to the right. Anytime they kind of stall out, those are kind of the points that you take the most notice of, specifically CPI. That one is, if it ever starts going down, that's a problem.
Sure.
That's a bad sign. So I'm going to move on from those few things. I'm just going to kind of quickly go through on this list some of the energy items that we added this week. We added several of them actually, and most of them are concerning energy prices and energy volumes. Actually, the gross majority of them are energy volumes, and these are kind of measures depending on your exposure to this in the transportation sector. There are going to be a lot of things. If you're doing oil and gas, things of that nature, that has a big impact. Even if you don't haul oil and gas, what's happening in this sector will impact overall capacity in the market, as we have become the #1 producer of crude oil in the world over the last year or so. So what that means is all these trucks, and we don't have the pipeline capacity over
so
there.
What does that mean? What do you mean we don't have the pipeline?
So most of the oil is legitimately put into a pipe. It goes underground, and it's pumped all the way to the refinery, where it's turned into things like diesel fuel,
Right.
where the truckload carriers purchase the fuel on the rack, and it's then hauled to their facilities if they have those kind of pumps. The problem is that pipeline cannot, it's literally, you have to think about it like a big giant funnel. So they're pulling all this oil out of the ground, and then they keep dumping more and more as they're finding more and more wells. They create more and more oil, and eventually it kind of floods. Like they can't pump any more oil in there, and the funnel overflows, not literally, but figuratively speaking. Yeah. That has to go on a truck, and a lot of the truck drivers will go and haul this for them. I mean, I don't know if you've heard, but all the traffic out in West Texas is turned into a disaster because it's just constantly filled with trucks. And this is expected to continue to expand over the next year, which is an additional like 300,000 truckloads over the next little bit. So it's annually. And so it's, if they don't do anything, they're not scheduled to expand the capacity on this pipeline to the point that it's needed to handle this volume for several years now. So,
and to go even further, so doing these moves, are these via truck, are these kind of close regional local moves, and are they very highly wanted? And
the drivers, a lot of the drivers will get paid a lot more for these moves versus the others. So it's going to draw drivers away from the large carrier populations unless they're specifically tied to this industry. They're also going to, they're mostly regional moves as they move it down to Houston, which is then put on a ship and either shipped off into the world, or then there's also pipelines that will redistribute it throughout the country.
Sure.
To other refineries, but most of the refineries are located down in Houston.
Yeah, and I think this is a good example of, having your network, whether your mode of transport, whether you're a shipper, carrier, broker, and, thinking that you're only affected by what happens in produce, or what happens with drive-in, or what happens with flatbed equipment. But I think this is a good example based on what you've laid out, that, knowing the bigger picture and understanding that, where this may be something that most folks think does not affect them at all, it's something really valuable to know about, because it could be affecting the number of available drivers and capacity in the other surrounding markets.
Yeah, and I'm going to pull up one that I think will be actually pretty relevant to any carriers out there. This is as we talk about kind of fuel consumption and things of that nature, as we get, we just had one of the biggest years in terms of truck orders. New orders were up. I can't even remember the exact number, but they were up significantly year over year versus the previous year. So that means that we're going to have a lot of new equipment, and they should be getting a lot better fuel economy, which is another index that we added over the course of the week. It's not quite completely finished yet as I talk to our data science team, but we do have a segment in there right now that I'll show you in a second. But here's a number, basically the fossil fuel consumption rate for the transportation sector. It's not the rate, but it's the amount in trillions of fossil fuels that the transportation sector is consuming. As this kind of, you don't have to know that it's trillions, but it's literally like how much, and that includes maritime and all sorts of things like that. So keep that in mind. And as this number kind of grows, that's going to mean more demand, et cetera, on the oil industry, which is a fossil fuel created by dinosaurs.
The dinosaurs.
They're dead. Hence the name. And then I'm going to show one more before briefly kind of exiting the energy sector. You can look through here, those of you that are interested, petroleum exports, consumption. I'm not going to go through each line of this, but for those that are in that kind of space or interested in that sector, they can go through there. It is most of this data comes from the EIA. The Department of Energy kind of gathers most of this and then produces this monthly. So just so you know where these sources are. There's one more in here that I wanted to say, and this does not come from the government, but fuel economy, MPG, as we're seeing this value kind of, we're right now, this is just a snippet. This is 2016's number. So 6.4 miles per gallon is what heavy duty trucks are getting as of the end of 2016 on average. we're going to watch this number. We should be seeing this number start to increase, specifically as we get some of these newer trucks, and on the road. I think a lot of fleets are measuring about over 7.2, 7.3 miles per gallon. Mm-hmm. It'll be interesting to see what the overall impact the rest of the country is as that moves forward.
No, definitely. And as we look at some of this fuel-related, oil-related data, I think it's a nice segue into some of the data that we have in analyzing on the carrier side with the DOE, which is what a lot of our fuel surcharges in the industry are based off of, whether it be nationally or via the PAD regions, and just kind of talking us through some of these as it potentially relates to some of the things you've already shown. What are we looking at here?
So yeah, I think for those of you that watch FreightWaves or read FreightWaves articles, we've talked about this a little bit over the last period of time. The difference between the rack price and the which is the wholesale price, mm-hmm. and the retail price, which is this price up here in the red. The retail price includes things such as transportation to move the oil, the retail markup, taxes, everything like that is baked into this DOE.USA rate, which is the one that the carriers base their fuel surcharges on. So mm-hmm. from, at $3 to $3.04, you're going to get charged, probably like 31 cents a mile. Mm-hmm. Whereas you're going to get charged, if this falls to $2 and to $2.04, you're going to get charged 21 cents a mile or something like that. Right. LTL carriers use a fuel surcharge percentage based on total freight charges. Mm-hmm. But as this kind of fluctuation happens, so you see right down here in the wholesale price, the rack price, if you will, it moves at a different rate than the retail price. You see the retail price is actually a lot smoother. Mm-hmm. So there's little micro kind of situations where carriers are making money on fuel or losing money on fuel as they kind of expand and contract. And we call that the fuel spread. And that's represented here in this, we have this index based on, let's see here, USA, there we go.
So what sort of things drive this?
Well, just to finish the point out for a second, then we'll go into that. The importance of this is basically carrier margins are going to get a little boost when this expands. So back here a few months ago, this was the highest level it had been all year. You see this huge bubble right here. And anybody that pays attention to carrier earnings, which I know you do consistently, Brad.
Bookmarked on tablet, computer, and phone.
A lot of carriers had really good fourth quarters. And here at SONAR, we noticed that volumes were actually kind of down. And so the rates have also been somewhat down. Well, carriers will get a nice little boost from this fuel expand. It won't be a huge amount of boost, but it could be as much as 1% to 2% to total overall revenue. If they're purchasing at the right time, obviously, if they're buying it at the low point and then, the fuel is still high, mm-hmm. As that kind of catches up, this is what happens right here. They kind of go back to normal where it should be, a brief spread, because it's essentially they're buying low and able to kind of not necessarily sell high because they're not passing it along. Right. It's just that the way that they're charging the fuel is a little bit lagging mm-hmm. in the way that they're purchasing the fuel. Sure. It's not as representative. And that's another kind of tie-in to some of that oil data. Like mm-hmm. as we produce more and more of it, you're going to be able to buy fuel cheaper and cheaper. But most people don't understand that since America is a huge producer of oil and crude now, that has a huge impact to the overall economy. In 2016 was one of the worst years, and we used to look at the DOE as kind of an economic indicator back in the day, at least where I was, just to kind of tell, because as the rate gets higher, it's actually better for the economy because we're the ones that are right. making it. And as we produce more and more of this, it also just filters through our economy. So it's not just us that's buying our oil. It's like China and other countries like that that are also purchasing it, which means that more freight will be moving, the better our economy does. So we actually kind of want the fuel price to go up, as weird as that may sound, even though Trump, I think, put out a tweet this week about, hey, guys, easy on the easy on the price of oil this week, and it actually dropped the price a few percentage points. But yeah, 2016 was a notoriously weak year for the freight markets, and you can see that was a lot of that had something to do with the fact that we are a big oil producer now, and we've had a big industrial economic expansion since this rate has started to come back up. A lot of people don't know that.
No, I didn't. I learned something new today, but that's typically what I go for.
Well, now you see that the rate is actually kind of falling back down, and if I'm going to pull up the volumes, you're going to see in tender rejections, they're going to have done the same thing effectively.
Let's see. What are we looking at here?
Just so they're two disparate things. You're going to see here, I'm going to pull this one out all the way to a year, and it just kind of falls right down as we're coming out of 2018. Tender rejections go down, which again, tender rejections, if those of you that are not, I know we have new viewers every week. That we haven't really mentioned the fact that this is not necessarily a 101 webinar. For anybody that has not seen the tender rejection index at this point, certainly reach out to us. Be sure to go to freightwaves.com/sonar to check out some of our stuff, and also don't hesitate to reach out to us.
Definitely. And yeah, as we go into probably the last 10, 15 minutes here, we will open up for questions again at the end. But as we've gone through here, I think you provided some really great insights into different things that are driving not only the economy, but also, transportation, spend, activity, which I think can be valuable across our shippers, carriers, and brokers, of course. Absolutely. And bringing you back in, I want to focus a little bit more on our carriers. So I want to do our last, 5 to 10 minutes here to look at some of our TCA data that we have from the Truckload Carriers Association, and looking at some of our OR numbers from some of the TCA data, along with revenue per driver per week, and just providing some insight into these two numbers. What are we looking at? Consolidated, maybe company?
Yeah, so we're looking at consolidated operating ratios, which for those of you that don't know, that's basically a measure of operational efficiency. For every dollar spent, roughly we're looking at about a 10-cent return on that dollar, operationally speaking. That excludes things that are on, interest accrual, like anything like that below, like, I'm not going to get into the accounting of it, but
please don't.
Effectively, this includes things like every dollar spent on like driver wages, maintenance, anything involved in the operation itself is measured in that number. And how efficient you are, the lower this goes, the better it is, obviously, because it's effectively, you're making 10 cents on the dollar when it's at a 90 OR.
Sure.
So you wanted to pull up the revenue per driver per week as well.
Yeah.
In comparison. So I'm going to put that on a dual axis, which is one of our newer features that we've added, which I'm a big fan of. I know you are as well, Brad.
Oh, yes. What are we seeing here?
Let's get my screen back out. I think it's, hold on, let's put it on relative. Might be better. Not let me get back too far. It's making it go wonky. But anyway, it's better if I think, put one on here for the moment. Here.
Try to challenge you and look what
I know. You're challenging me. Here, I'm gonna pull them up independently.
Okay.
That'll probably be better. So revenue per driver per week has actually gone up over the last bit. I think most people will understand what this number is. Anybody that is spending, they're getting more money for every driver that they hire. So that's kind of a measure of operational efficiency in itself. So that means that these drivers who they hire are actually producing more revenue, so they're more effective. You want this number to be as high as possible, because that means that you're getting the most out of your organization and your people. To pull up the OR, which again, going into the fourth quarter of 2018, this number was still very high in relation to the previous year. And these are really useful looking year over year comparisons, even though I typically don't like to get lost in kind of like these time analysis. Last year's gone. It's not really going to help you, but it does give you a point of reference to see just how far you've come year over year. We were talking about the CPI earlier. This you also have to keep that in mind. Like any kind of inflationary costs or measures that you have, you can pull those up and put them next to things like your revenue per driver per week. So if your CPI went up the same percentage as the revenue per driver per week, you've effectively just played the exact same deal as the rest of the market.
Sure.
So you're doing better, but you're not necessarily doing better versus the house, if that makes sense for people that go to casinos. The house has still got you. Like you're still not coming out really ahead, because this is just revenue. This isn't profit.
Mm-hmm.
So
13. How do they correlate with your ORs?
They actually the CPI and stuff will actually correlate with this. Oh, you're talking about the OR. So the revenue per driver per week actually does correlate with the OR going up, because, like I said, they're both measures of efficiency in terms of how you're managing your operation. Mm-hmm. The more revenue that you're able to put on your, and I shouldn't say that exactly, because revenue can cover up a lot of operational deficiencies. So if you're getting more for doing the same amount of work, it's not that you became more efficient, it's just that you got more for it. Mm-hmm. So, but it's still good because you're still getting more money for doing the same thing. So that is good. But ORs go up in a similar manner. We'll pull that one up next just to kind of show. The asset-based carriers have done pretty well over the last bit, something that we've been tracking quite significantly. So these ORs actually go down when they're good. Right. So unlike the driver revenue per week, which actually goes up and to the right, this one going down and to the right is actually a good measure.
Just think Tiger Woods. Right? Lower score is better.
Lower score is better. It's golf. So a 90 OR is really good for a carrier. I know that in my past life, operating at a 95 was celebrated. So that means we're making 5% in terms of margin. So brokers out there, I think, they can target a lot lower percentages. Mm-hmm. But carriers and stuff have the burden of assets to manage. So it'll be interesting to see what these OR numbers do coming out of the first quarter, as we've seen volumes kind of drop off a little bit. But except over the last few days, we've had a big old spike. Pull up a baseline to make this a little bit easier to see. So for those of you that don't know, this is our Outbound Tender Volume Index. It is an index based on March 1st value of 2018, and the base level is 10,000. So what that means is, for today, we're looking at about 1.24% lower volume today versus March 1st of 2018, which was considered to be a banner year.
This is fascinating.
Yeah, so we have had a cooling off period here in the last several months, but the last few days, the Outbound Tender Volume Index has shown signs of life. Now, this isn't unusual for an end of the month.
Sure.
We saw the same thing around here in January, but the fact that it's shot up so fast, it's literally come up about 3.1% over the last 2 days, is an indication that we might be kind of breaking out of the winter kind of cycle. So there is a seasonal impact. You see in here in March last year, we kind of increased our volumes, I think about 3 to 4% higher over the month. Tender rejection rates were really high at this point.
Well, so I was going to say, if you lay over, that's, I think, a really telling, now that we're about a year or almost exactly a year from when this volume data was indexed. I think
that's actually a really good point
really
that I need to make. So over the next, here in 2 days, we're essentially going to have year-over-year data for the majority of the country, where we've had it in the 6 big lanes, Atlanta, Chicago, Dallas, Philadelphia, Los Angeles. We have not had year-over-year data for this index until Friday for the majority of the country.
Which leads me to my first question that I want to ask in the Q&A, if you guys don't mind if I kick things off in the Q&A here. In working with, being maybe not the most popular time, but certainly a lot of RFPs going out and being considered right now, what type of data within SONAR would you use to help you?
I would stick with our good old reliables, outbound tender volume indices, inbound tender volume indexes as well. Really, I'm going to have to make kind of kind of a plug here for, the use of the API.
Oh no, don't do it.
Because as an old pricing guy, I want to see the data, and the more you can kind of overlay your own data on top of Sonar's, the value really becomes quite apparent. Like the API, being able to kind of pull that into your own space and overlay it to see where your operational kind of imbalances are, that's going to really give you the best chance at kind of lining up, not just winning the business in terms of measuring year over year information, what the market conditions are like, so that you can adjust your margins appropriately, but also to figure out, is this a business that I need to be more aggressive on, kind of lower my contribution margins, which are basically the idea there is that you're going to, it may look like that potentially isn't a great fit for you on paper, whereas the direct revenue or the price looks like it loses money. But effectively it fits in your network more effectively than some other type of business. So you're going to be able to actually see kind of the double benefit of having that business on your trucks. For instance, you're looking at me kind of confused, like,
well,
so.
I was just going to say kind of like a tuxedo t-shirt or something.
Sort of, yeah. You want that in your back pocket? Everybody has one already. So say that you haul a lot, you have a shipper in Dallas and they go to Fresno a ton. Well, there's a shipper in Fresno, bid package comes out, and you see that, you overlay the Sonar data and you see effectively that the market conditions in Fresno have deteriorated. You can actually be a little bit more aggressive in getting that business, because you need to be able to move your truck out of Fresno, because you're going there every week, all the time, and there's nothing there. Go get, the market itself has deteriorated. You need to be as aggressive as possible to getting some Fresno business.
No,
yeah.
I think that's great insights as always from Mr. Zach Strickland. I think we may have a couple questions asking about operating ratios and brokers. What's typical for a broker OR?
Broker ORs tend to be in the mid 80s. You certainly have a range between 80 and 90 that's considered more effective, and that's because they don't have the overhead to deal with. They effectively have a sales force, and it's much easier to maintain or manage the employment level there versus a truck. Maintenance cost, you've got acts of God that'll, you also have claims and things like that really hamper a carrier's ability to really grow quickly. They can't just jump out into the spot market like a broker kind of lives in a little bit. Now, to that extent, the broker is also exposed to, kind of market contraction a good bit. But whenever the market's going up or down, the broker is generally operating in the mid to upper 80s.
Hopefully that answered that question. If you need further assistance or insight for that question, or anyone has any further questions, we'll hang on here for another few minutes, but you can always reach us at freightwaves.com/sonar, or of course any of our users that are on the webinar today, reach out to us direct through the Sonar platform. And again, thanks for joining us. We'll hang on here for a few more minutes if anyone has questions, but if not, have a great week, and we'll see you guys next week at 2 p.m. Eastern. Thank you. All right, thanks again for joining us. We'll catch you guys next week. Zach and Brad signing off. Have a great week.